50-year fixed. Has there been a bigger mortgage bombshell that's been dropped a long time than the conversation of extending to a 50-year fix to impact affordability? Not that I remember in the recent history. So let's talk a little bit about, does that make a lot of sense and what impact could that have on the market? Well, let's be realistic up front. The reality is we have no idea, because one of the biggest questions that needs to be answered is one that we don't know, and that's, what's the rate on this product going to be? Is it the same as a 30-year fixed? Traditionally, shorter term loans have lower rates. So let's just talk hypothetical in the market today. If I look at the Freddie Mac averages for a 30-year fixed, it's 6.22. If I look at the national average for a 15-year fixed, it's 5.5. So there's about a 0.75% difference. So let's make the assumption that a 50-year is probably going to be at a slightly higher rate because it offers you a longer term, it offers you more security, and it has the same general principle of the difference between a 15 and a 30. If we did that, that average today in the market of 6.22, according to Freddie Mac, would make a 50-year fixed rate about 7%. Again, this is all hypothetical. We don't really know. So what impact does that actually have if you're making those payments? Let's take a quick look. I've got some analysis here. So this is a 30-year fixed at 6.22. This is just for your principal and interest, and I use the national averages for what we're looking at. National average says that the average purchase price is 400,000. People are putting on average about 16% down. So I went with those numbers. If we did that, your principal and interest plus a little bit of mortgage insurance would come to about $2,200 a month, 2202 to be specific. If I went in with a 50-year fixed and assumed that it's going to have the same general spread as a 15-year fixed to a 30-year, then what I'm looking at is the difference of the payment dropping to only $2,161. That's only a savings of about $40 a month. So it really doesn't move the needle a lot. Now, I can go in an extreme example and say, what if the rates are the exact same as you would have in a 30-year fix? My opinion, that's not likely. It's probably going to have a little bit of a premium just because of the type of loan it is. But if you did, your payment would go from the 2202, it would go down to 1963. So you're saving there, roughly about $240 a month, which does move the needle a little bit. Let's talk about the drawbacks though. So if I'm getting into a 30-year loan, we all know that over time you've paid in a lot of interest. Over the life of this 30-year loan, you would have made $742,000 in payments, with $406,000 of it going to interest. If I switched to this 50-year fixed and I use my 7% rate as an example, that number balloons up to paying $1.2 million for a $400,000 house, and $877,000 of it going to interest, which is over double what I was paying on the 30-year fixed in my example. The other thing you want to look at is loans don't accumulate interest and principal at the same amount for the entirety of the loan. The first years are very interest heavy, and then it becomes more principal heavy as the loan moves on. So if I'm in this loan and I refinance 5 years in, on my 30-year fixed, I've built up about $23,000 in equity for paying that loan down. In this example, if it's a 7% rate on a 50-year fixed, I've only built up $4,500 in equity. So I really haven't built a whole lot in that scenario, and I'm paying a lot more in interest. The reason that's important is, even though it's a 30-year and a 50-year fixed, the reality is people don't really hold on to their loans for 30 years or 50 years. You're holding on to it for a shorter period at a time. The average person holds on to their loan for about 7 to 10 years. That number's ballooned up a little bit because all those COVID loans that are in the 2-3% ranges, people aren't getting rid of them. So the overall scenario, depending on where they set the rates, is really going to determine how impactful this is. If it follows the same suit as a 30 and 15 year and having a little bit of a spread where you're paying a premium for it being fixed in for longer, then it might not be that much of a difference. Like I showed you here, it's only about $40 a month on a $400,000 purchase. If they keep rates the same, saving about $240 a month could make a difference on affordability and could impact it. The thing you really need to watch out for is you're paying a lot more in interest in the long run should you keep the loan for a longer period of time. And you're really not building equity at a very aggressive rate. So you want to keep an eye. If you are planning on selling the home, hopefully the market doesn't drop and you don't wind up underwater on your house, or trying to refinance can be a little bit more restrictive. I hope this helps. I hope everybody has a great day. Take care.